Welcome to Volatility Trading Strategies. So yesterday I posted an open question to our VTS community about which trade type would be best given the current bloodbath that we're seeing in emerging markets, which are down about 20% so far this year. I thought it might be helpful for me to include everybody in my thought process for how I select trades, what I'm looking for, few things to be careful about, basically how I'm going to play the collapse in emerging markets. If you do want to join our community, that would be great. You're more than welcome, and I'll leave a link where you can do that. It's totally free, of course, and you'll see my research, articles, videos, every single day. And of course, you'll also get access to some live trades for a period of time, so you can see exactly how I manage my portfolio. But let's get into the trade. So let me set this up the same way I did for everyone else. In this top section, we're looking at the iShares MSCI Emerging Markets ETF that goes by the ticker symbol EEM. And you can see that the EEM is down over 21% since its high in January of 2018. If we go by the rudimentary minus 20% rule, this qualifies as bear market territory, so it's been pretty ugly so far this year. And just as a point of interest, this is a chart showing the performance of both emerging markets, EEM, and the S&P 500, the SPY. You can see that for a year they were tracking quite closely. But after the correction from February to April, the S&P 500 has now fully recovered and recently made a new all-time high, whereas emerging markets continued lower and are now down 21%. This is a strong divergence and one I'll be watching closely going forward. Now, this bottom chart is the Chicago Board Options Exchange VXYEM, which is a volatility index for emerging markets very similar to the VIX index, which everybody knows and loves. So the higher the number, the higher emerging market implied volatility is, and vice versa. Sitting right now about 22, this is in the upper half of its readings of the last 12 months, and in the upper quarter of readings for the past 24 months. So that's how I framed it. Emerging markets are down 20% in the last 6 months, and volatility is elevated. Any option trader out there is going to see some opportunity here. But the big question is, what is the most suitable trade given the current market environment? Now, we had a lot of engagement from the community, and many great ideas were presented. Now, I do want to say that while I've personally been very successful trading options using my style over the years, it is important to remember that there are more ways than just one to make a great rate of return. So what's most important is what works for you. But let me go over the most common ideas presented by members of our community, why I didn't favor those particular setups this time around, and then I'll reveal some final conclusions. A lot of people mentioned a simple long call option, which isn't surprising. When something is beaten down like EEM right now, it's natural for people to want to play the contrarian and see if they can profit from a recovery. Remember, a call option profits if the underlying goes up. But that's also the first problem. That's the only way the trade can make money. It's entirely directional. Now, there's nothing really wrong with making directional bets sometimes, especially when something is down so much. But with call options, even if you pick the right direction, the second problem is you still have to get the timing right as well. It's not enough for emerging markets to just go up. For this call option to profit, it has to go up pretty soon. Call options are what's called theta negative. Theta is a Greek symbol that tells us if all things are held constant, what our profit will be after the passage of one day. Side note, I will be talking about some Greek symbols today, theta, vega, delta, so if you want to know more information about what exactly that means, I do have an article on my website you can check out that goes into far more detail, but they're very important for option trading. But now back to the long call. So this long call option being theta negative, if nothing major happens from today to tomorrow and EEM just stays where it is, this trade loses money. If it stays flat for a week or two, this could start to test any stop losses that are in place. Bottom line, for a call option to make money, it has to go up in price and it has to happen pretty soon. All other outcomes are going to result in a losing trade. Obviously, if it goes down, you're going to lose money, but even if it stays flat, you're still going to lose money due to theta decay. If you don't mind being directional, I think in this case you'd be better off just buying the stock outright. At least then, if it doesn't move, your capital remains intact. And if it's leverage you're looking for, then margin accounts do actually allow for that. And then, of course, there's also some leveraged emerging market ETFs out there as well. They do carry their own set of risks, and they aren't a free ride, but I would still favor them over the long call. So that brings us to the second option type that was most talked about, and that's the long straddle. The long straddle solves the problem of directionality because it's both a long call and a long put purchased together. So this trade profits if the underlying moves in either direction. We can make money if the EEM recovers and goes up, or if it continues to crash and goes lower. This increases our odds of being right. But just like with the call option, if the EEM stays flat in this range right here, the long straddle is also theta negative, so it'll bleed money daily and eventually hit the stop loss. But worse than that, both long calls and long straddles are what's called Vega positive. Vega is the Greek symbol that tells us what our profit will be given changes in volatility. Vega positive, like this straddle is, means we profit if volatility rises, and we lose money if volatility declines. But remember, I showed that EEM volatility is already in its upper range. It's not a very good idea to open a Vega positive trade right now. The more likely scenario is for volatility to decrease going forward, and that will cause this straddle to take losses. So while the long straddle does solve one of those three problems that the long call suffered from, in that it is a directionless trade, it is still theta negative and Vega positive, which we definitely don't want in this current environment. The third option type that was shouted out by members is one that I actually trade quite a bit myself, and that is the calendar. I'm going to do a dedicated video just for calendars very soon because it really is one of my favorites. But for today, I'll just say that it checks 2 of the 3 boxes for the right trade in the EEM. It's market neutral, as you can see, so we don't need to commit to choosing a direction. We just don't want it to move very far, but we really don't care if it's up or down a little bit. And importantly, it's theta positive, the opposite of what the long call and long straddles were. Theta positive means we now make money every day that goes by with no movement in the underlying. That's a strong position to be in because more often than not, things do remain fairly calm. The big red flag here is that calendars are Vega positive. They profit from a rise in volatility, and I wouldn't open anything that is Vega positive right now. So that just leaves 2 option types remaining, and we have to choose the best of the 2. First, the Iron Condor. Now, because this is my favorite option spread, I have done a few videos about them already, which I will link here in the top of the screen. You can check some of those out later for a much more detailed breakdown of the pure awesomeness that is the Iron Condor. But basically, they are market neutral, theta positive, and Vega negative. So the Iron Condor seemingly checks all 3 boxes we're looking for here. That means we're done, right? This is the one. Well, not so fast. There is one thing that can kill an Iron Condor pretty quickly, and that is a large price move in either direction. Now, no trade is perfect, of course, and we always have to accept a few disadvantages. The options market itself is very efficient, and there is no such thing as free money, so all trades have risk. The issue here is, when something gets beaten down as far as emerging markets have, the odds of a substantial bounce, at least in the short term, is higher. And if that were to happen, an Iron Condor could get stopped out within a few days, and it's really frustrating when that happens. So the Iron Condor is a really good option, and I definitely wouldn't fault anybody for opening one on the EEM right now. But for me personally, I do like to see a little bit of a basing pattern and a few days of stability before I open new Iron Condor trades. And that could happen pretty quickly. If EEM recovers just a few percent here, I'd be more inclined to open an Iron Condor then rather than now. But I still do want to be theta positive and Vega negative, so what's left? This is called a bull put spread, also sometimes just called a vertical or a credit spread. These trades are best used in combination with technical analysis when the underlying is in oversold territory or at a strong resistance line. In our case today, it's more of a bet that we are in oversold territory and likely to see a bounce. And the benefits? The bull put spread is theta positive early on in the life cycle, so if nothing happens and the underlying just hangs out in this area, we will slowly earn a profit. It's also Vega negative, so if volatility comes in a little, which I believe is the more likely scenario over the next few weeks, we will profit from that as well. The only downside is it is a directional bet. We do want the EEM to recover and go up from here. But like I said, there's nothing wrong with making directional bets as long as we don't get hurt by a lack of movement, which happens quite often. So hopefully that was helpful for you to see my thought process as I'm going about selecting trades. And that's the great thing about options trading. This is not static buy and hold investing, where most of our time is just spent waiting. With options trading, wait a day and another opportunity will present itself. Emerging markets right now are begging for us to take a trade, but the S&P 500 is also near all-time highs. That's an opportunity. Gold and precious metals have also been crushed. Opportunity. Apple and Amazon are way ahead of the underlying NASDAQ index. Opportunity. They're everywhere. So what's the best trade to take on emerging markets right now? Well, just to review, I wouldn't personally do long calls or long straddles because, again, they are theta negative and Vega positive. And as much as I like them, I wouldn't do a calendar here either because it's Vega positive and volatility is way too high for that right now. So we have two choices left, and both of them are completely viable given this current environment. So it really comes down to whether you want to be directional or not. If you don't, and you want to leave a little bit of room on both sides of the trade, then the Iron Condor is going to be the right one for you. If you're like me, and you think this crash in emerging markets is a little bit overdone and maybe we're due for a small bounce, then the bull put spread is also a great trade to put on right now. So go ahead and email me any questions that you have. And like I said, I do invite you to join our VTS community, but thanks for watching. So go ahead and click the link right here, sign up for the VTS newsletter, and when you do, you're going to get full access to all of my trading strategies for a full month absolutely free. And if you are new here, please consider subscribing to my channel. Also, if you have any questions or comments, I'd love to hear from you. So go ahead and leave those in the comment section below. See you next time.